In this video, I'm going to talk about an important subject that no one talks about once again. Not surprisingly, no one talks about this because it's a sensitive idea, and there's a lot of people who will not like what I'm going to say, but the truth is more important than people's opinion about something. As you might have guessed already by the video title, I want to talk about the difference between real trading education and fake trading gurus. The reason I'm doing this is that amateur traders don't know how to tell the difference, so they end up getting attracted to the wrong things and ideas when it comes to trading. The result is that they put their hope on something that is not worthwhile, they lose time, and they lose money. So this video is an attempt to set this record straight. The first thing that beginners and some advanced traders who suffer from too much hope and silly ideas should understand is that the trading education business has been around for a long time, and it will always be around because there is a demand for good quality content. However, in the last 10 years or so, the ease to open a trading account, the large decrease in the minimum capital requirement to trade an account, and the large increase in the amount of leverage made it possible for the appearance of fake trading gurus. A number of years ago, opening a trading account wasn't that easy. You had to go over a tedious process regarding your personal documents, the capital requirement was much larger, and once you had the trading account, the leverage wasn't nearly as absurd as the leverage you see nowadays. I remember trying to send money to a brokerage in the US or in Australia. The bank in my country was having a hard time figuring out what a broker was. So we need to analyze two things here. We need to analyze what caused this, and we need to analyze the consequences, the cause and effect. In 2008, around 13 years ago, we had the financial crisis that was born because banks started to lend a lot of money to people who didn't have enough collateral. Long story short, banks took an enormous amount of risk, and when people realized there was a housing crisis, banks began to suffer the consequences. At that time, derivatives, which is how banks transfer some of the credit risk to the financial markets, were very poorly regulated, and in the aftermath of the crisis, the need to transfer the enormous risk to the financial markets increased a lot. In summary, the way banks have to decrease their risk in credit operations is to transfer this risk to the financial markets, which means transferring this risk to other investors or traders through the derivatives market. However, and this is the key point, for that to happen, a lot of liquidity and volatility is needed. The more the better. The way to increase the level of liquidity and volatility in the market in a dramatic way was to relax the regulations for the retail traders to enter and trade the market. In other words, it became much easier to open a trading account, and the amount of leverage in these accounts went to the stratosphere. Imagine what happens with the liquidity and volatility of the markets once you have hundreds of thousands of small retail traders entering the system. By the way, there is nothing wrong in this relaxation of regulation, but it does transfer the responsibility to small retail traders in the sense that now they have the obligation of knowing what they are doing in the market. Otherwise, they will get crushed by their lack of education. This whole situation solved one problem, which was the ability of banks to transfer risk from credit market to the financial markets, but it created another problem, which is the rise of fake gurus that sell empty promises to unadvised retail traders. A lot of retail traders enter the market because they are desperate or they want to make easy money, and they neglect the fact that they need to study a lot if they want to have any sort of solid result from trading. When you have people like that in the demand side, you're going to have the counterpart in the supply side. In other words, when people are filled with greed and empty hope about the market in the demand side, you're going to have someone selling empty promises in the supply side. And when these two people meet, business is made. So if you want fake trading gurus to stop what they are doing, you have to do your part of the job and stop wanting to make quick and easy money. Without demand, there is no supply. It's in this moment precisely that we need to differentiate the real education market from the fake gurus who sell empty promises. And I'm going to teach you how you can tell the difference. Fake gurus will do just that. They will promise you exactly what you want to hear, and they will show you what your life could be if only you follow their advice. One thing you're going to notice is that fake gurus never talk about the scope of knowledge about the market, and if they do, it's usually something very shallow because they probably don't know much about the market. And talking about planes, trips, supercars, and all of that has a much stronger message. The sad thing is that with this enormous leverage in the markets, it's indeed possible to have such returns, even though they are extremely unlikely. But people tend to focus on what's possible rather than what's likely or not, because they are biased toward their own success. A major force in this whole thing, of course, is leverage. Leverage distorts traders' perception of their own abilities. So an amateur trader might make 200% return in his first trade without knowing anything about the market, and of course this trader will start to believe he's a genius. Needless to say, this has nothing to do with intelligence, but it has to do with an evil mixture of luck, distorted perception, negligence, too much hope, plus a few statistical traps I'm going to leave for another video. These traders don't understand the long-term effects of over-leveraged trading, so they keep getting catapulted back to the starting position without understanding why. And they keep seeking for the one technique that will enable them to double their trading account over and over again, as if it was something easy to do. All you need to absolutely destroy fake trading gurus is to eliminate leverage. All of them will be out of business by tomorrow. However, the real education business will still continue because it's not about the returns. It's about learning the right things. Sadly, leverage is not going away because it's interesting to institutions to create more volatility and liquidity on the backs of retail traders. Meanwhile, the fake trading gurus will suck the life out of unadvised retail traders. So the point I want to make is that the real trading education business is about the scope of knowledge of the markets. Fake trading gurus just make promises. That's how you tell the difference. So the cost of banks decreasing their risk is the new wave of fake trading gurus. The lesson in all of this is that you, as a small retail trader, should seek good education in order to avoid the fake trading gurus. Good education is once again the savior. Of course, that presumes that you understand what good education is, but that's a subject for another video. So that's it for this video. If you like the content I create, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications button, and leaving your feedback below in the comment section. Thank you for watching, and I hope to see you in the next videos. Take care.